Hello guys and welcome. In today's video, I'll be showing you how to solve the issue with the emergency loan in the early rounds of the simulation. And I've been having many emails on emergency loan. So today I want to talk about emergency loan. So if you look at my screen, we have the selected financial statistics. Here we have the return on sales is negative 11.4%. Return on assets for the Andrews company is negative 8.7%. Baldwin had a better percent compared to Andrews. The return on equity, negative 22%. These other guys had a better percent. Emergency loan, they had 51 million. These other guys had none. The contribution margin, the magic number is normally 30% or more. So if the more the contribution margin, the better. So, but we normally prefer you have yours more than 30%. So Chester had 30.1%, he was good. Baldwin had 32.7%. So if you look at the market share, Andrews had 20.0%, and you might be wondering why they get the emergency loan, yet they had this huge market share. So if you look at the stock market summary, Andrews, the price of their share reduced by $82.75. So that's why you can see them, they are closing at $10. So this is the trend. You can see how it dropped. Then, so before we look at the cash flow statement survey, let's look at the production analysis. This is where you'll know how and what happened and why did it happen. So we see that they had the 4 products. So definitely here was thrift, then S was thrift, O core, then Arc Nano, then Able is Elite. If you look at you can see that definitely the first problem that I've seen is that they overpriced their products, because thrift, it starts at normally 26, so it's advisable that maybe you put it to 19 or 20, but these guys overpriced. So that's why they did not sell anything, because they overpriced their unit. And because they had this huge inventory, forgetting that they had material cost and labor cost. So it's like they produced goods, and they spent money on labor and material, yet they did not sell anything. Then in terms of automation, it's normally advisable that with the thrift and core, you automate them to 10, especially the thrift, you automate them to 10 as fast as possible and as soon as possible, so as to save on the labor cost. So with L, he sold around 321. Again, he had this huge inventory. For Arc, which is the Nano, he sold 1,000. This is, let's say, 1 million. He had 149 units in terms of inventory. Here he sold 1,209. He had 396 units inventory. So with the Nano market, I think they forecasted very well, because if you're having units that are less than 200, you are great. Then if we start with the individual market segment, with the thrift, they had you can see that they didn't have anything in the thrift market segment. That's because they overpriced their products. You can see that they placed their products at $38, and most of the under the customer buying criteria of the thrift market segment, they want a product that is priced between $14 and $26. And what they did is that they went beyond with even a very big value of 38. So that's why they did not have any sale in the thrift market segment. So if you move down to the core market, you see that their product was L, and they sold 189 units. With L, you see that, so this is their product. So under the core market segment, customers value the price of between $20 and $32. So they priced theirs at $37. That's why you see they sold less than these other competitors. But the ideal age was the customers in the core market segment, they want a product with an ideal age of 2, so 20, which is 20% importance, and their product was close to 2. That's why they sold some of the units, because theirs was close to 2 compared to these other guys. And the third one, MTBF of between 16,000 and 22,000. They had an MTBF of 21,500. Again, it was good. In terms of customer survey, they had 2, which was not good. And they didn't sell most units, and this will result in them getting this storage fee for the unsold capacity, or no, sorry, for the unsold units. With the nano market segment, yeah, they did great. Like although they didn't stock out with this nano market, they had market share of 26%, which was not bad. They redesigned their products. Again, in terms of pricing, they did well. And the thing that I noticed with this report is that they wasted money on the promo budget and the sales budget, because you can't just splash money and in the early rounds so that you can get 100% awareness, because the this game, you are limited with funds, so you just have to plan yourself so that you don't waste funds. With the elite market, they had a market share of 24% again, which was not bad. They sold 982 units. Again, in terms of promo and budget, you can see they had this huge. Others are investing 1,250. They are investing even not even twice. It's twice with some value up, because they are selling 3,000 here again, which is not good. They wasted the funds on the promo and sales. So in terms of, if you go back to production, so let's move up to production. In the production analysis, you see that overproduction is one of the major causes, because this overproduction normally comes from this when you're over ambitious in the marketing department, and you produce goods. This result in you produce more goods than what the market demanded, and you may be having you may not satisfy the customers, because again, you may have customers that they don't like your product, so they may not ending up buying your product, and this will result in you having inventory. So the purpose of the video today was try and show you how do you solve when you have issues with emergency loan. So the first solution that I can give you is that you look at your forecasting in the marketing department, because this is the important department that will keep you out of the emergency loan. If you don't have a formula, you can send me an email. I'll give you a formula on how to calculate the values for the forecasting. Even if you don't, you can also have your own formula and make sure that it's working in the strategy that you are using. In terms of inventory, it is ideally fine to have 1 or 2 units of inventories. But if you have inventory that is less than 100, that's great. You'll not be having issues with emergency loan. Again, if it's between 100 and less than 200, it's okay, but not advisable. If you're having inventory ranging from 200 and 300, you might be having issues with your forecasting, and you should be looking at how you forecast. Then if your inventory is more than 300, this one will get you into troubles, and you might be at the risk of having a emergency loan. The next thing is, if you have emergency loan and you want to cut on the costs. So the thing that I can advise you is, so you just move to the HR in the human resource department. Here we are. You don't hire as many people as because you may not need many workers, and although you might lose some personnel, and you'll have to pay the separation cost, because the separation cost, this one they didn't have it. So if you send the employees home, you normally have to pay them some separation cost, although it will get into your funds, but it will save you in future. The third one is, pay attention on your pricing, because what these guys mostly did is that they didn't pay attention in their pricing. And if you look at your pricing, ensure that you are getting you are raising your contribution margin, because how much is the marketing? No, sorry, how much is the labor cost and how much is the material cost? This will impact your contribution margin. Price your product basing on the customer buying criteria and the range of the customer buying criteria. And know that if the higher the contribution margin, the better. And that means that you'll be making more profits. The third one is, no, the fourth one, I've said with automation for the products, with the thrift and nano, ensure that you're automating them to higher automations as soon as possible and as early as possible. This will save you on the labor cost. Then the fifth way of getting rid of the emergency loan. So let's move on to the total quality management. So the total quality management, you have it here. So I can see that they didn't invest anything in initiatives, and you can see that we have impacts such as material cost reduction, labor cost reduction. These ones will reduce the cost of labor and the cost of materials. Investing on the TQM initiatives to lower material cost will also help you. So if you go into the TQM page and you don't know what to do, there is an information button up there that will try and guide you on what to do. Lastly, you just check on your financials. So let's move to the financials part. Sorry, I might be fast, but I don't have much time. So we have the financial part, so the cash flow statement. And if you check in the finance page, we normally have the projected cash position for the following year that your product will be selling. You can check on it if it's not as what you want, or if you look at it and you feel that you might be risking getting emergency loan, you can take a long-term loan or long-term debt, and even short-term debt to finance your capacity and automation. You can also issue company bonds, and even in the production, you can decide to sell capacity. So I believe this video have been helpful. So if you feel like you can have any question, you can just send me a contact, and I'll try and see how I can assist you. So thank you, and be blessed.